Thank you, everybody, for joining for this, the April edition of Making Sense of the Markets with Chris Kerlow and Team LWC. My name is Mitchell Shields. I'm the financial planner with Team LWC, and I'm going to be moderating the session today. So this session, Chris is going to be, he's titled the session, Who's Swimming Naked? He's going to be talking a little bit about what I'm sure, everybody's been hearing about. I know we've been taking a lot of questions on with the Silicon Valley Bank fiasco and how that's kind of rippled through the markets and what changes we've made to the portfolios accordingly and how we're managing your money. I'm going to be watching the Q&A section of Zoom. So any questions you have, please throw them in the Q&A section, and we'll save that for the end. But without further ado, I'm going to pass things over to our team portfolio manager, Chris Kerlow, to give us this month's session. Take it away, Chris.
Right. Thanks, Mitchell. Really appreciate it. So our title is a little bit of clickbait. It comes from a famous quote from the Oracle of Omaha, Warren Buffett: "Only when the tide goes out do you discover who's been swimming naked." And that's what we experienced here in March with the fallout of SVB and a bit of a crisis through the regional banking sector. So it really started around March 8th when investors tried to pull about $42 billion of deposits out of Silicon Valley Bank, SVB. That rippled through the financial sector, dragging down regional banks and financials alike. It spiked up inflation, recession risks. Markets were fairly shocked by the news at first. And then things changed a little bit with the upcoming Fed meeting when we saw only a 25 basis point hike in March, down from the 50 basis points that the market was expecting just days earlier. Another rate hike has been largely taken off the table, and market pundits believe that this financial system shock has the impact of about a 100 basis point hike from the Fed, giving them some breathing room. Why? Deposits are likely going to be lower. This put a bit of distrust into the system. We're going to see tighter regulation, higher capital requirements, and all of that's going to lead to lower lending standards, much of which is kind of the impacts of rate hikes. And so with that off the table, the market looked through the storm and began a bit of a risk-on rally. We saw the NASDAQ rise almost 7% last month, back to its August highs. We've seen Europe lead things higher since October. Now most European equities are up about 30% on average. A lot of that is on the back of the Chinese reopening, which we believe is being overshadowed here. The Chinese government expects GDP growth in 2023 of about 5 to 5.5%. We think that could be on the low end, which is extremely positive for emerging market equities, generally speaking, as well as European equities, which we're seeing rise here on the back of that. That has pushed valuations up a little bit to about 18.4%, or 18.4 times in the state side, and then 13 times here in Canada. I'm going to dive into kind of what happened with SVB, as it's a bit of a complicated situation. I'll try to break it down. Feel free to ask any questions I don't cover. But basically, the Fed, we thought, was in a mantra of continuing to hike rates until something broke. This SVB situation was something that broke. Banks, as you all know, take money in from depositors, give them an interest payment on those deposits, invest the proceeds into longer dated bonds, typically treasury bonds, which are backed by the US government. However, over the course of the last year, yields on those treasury bonds have risen rapidly, deteriorating the price of the bond on the issuer's balance sheet. Accounting rules do not require banks to mark those bonds down because they're backed by the US government until they're sold. But what happened was, as depositors at SVB asked for their money back, they had to unwind those bond trades, marking a big loss in the portfolio. And the CFOs of a lot of those Silicon Valley startups realized that their money was no longer safe, all tried to take it out at the same time, causing this massive write-down. That caused the Fed to step in. They created a new program called the BTFP, which allows banks to borrow against their balance sheet at par. So even though the SVB bonds were trading roughly around 90 cents on the dollar, they could borrow at 100% to pay those depositors back. Kind of got a quick fix for the situation. We had another group step in and buy the rest of those deposits. The problem with what the Fed did was a bit of a moral hazard. They set a precedent to other banks that can now realize if they come in and do some unprudent lending practices, there is a possibility that there's a good chance that the Fed will step in and backstop them, no matter kind of how stupid or risky how much risk they were taking. That could be a big problem, to be honest, from this whole event. That's not really getting a ton of attention. SVB had incentivized a lot of these tech companies, many of which would get a large capital infusion on a capital raise to be spread out over the course of time, to hold that cash on their balance sheet so they can make a small spread on that money. In the United States, every deposit over $250,000 is uninsured. And so 97% of all of their deposits were actually uninsured. And so that's where, if it was insured, that's fine. That's what the bank or the Fed has agreed to protect, is that consumer deposit base. In this case, 97% of it was not insured. And, they came up with a new program to help not have a contagion effect. The roll-on effect of what we're seeing here from this comment I made at the start, that the Fed is going to keep hiking until something breaks, is a lot of companies like profitless tech companies, which have the way we would call that is a long duration. You're kind of investing into future earnings. That's going to take some time, but should be bountiful earnings at that point. Private equity has a similar type of situation, venture capital. All of those businesses, including commercial real estate lending, anything that's a function of keeping rates near zero, and large scale asset purchases with forward guidance that was suppressing volatility, was all built for an era of no inflation. So with inflation, there is some risks in those areas, and a problem that we see. Back to why this could be a bit like 100 basis point rate hike. 38% of all loans come from these small to medium sized banks. Even moreover, is 67% of all commercial real estate loans come from these banks. And so you can see it's just inherently out of market sentiment that lending program or programs are all going to tighten up, making it more challenging for those cohorts to get access to capital, which could in turn slow the economy. It's still early, and I would say that we're not completely out of the woods, but not all banks are built the same. We'll get into that a little bit later in the presentation. It was good to see that in that period of financial stress, bonds and cryptocurrency and other non-correlated assets did quite well, protecting portfolios. Another reason why we continue to recommend and diversify your assets across different asset classes. Another question we've had over the course of last month is, what is a hard landing, soft landing, and no landing? All of these really refer to, are we going to have a deep recession, a mild recession, or no recession? Surprisingly or not, the worst is probably a hard landing, where you have mass unemployment, big drawdowns in GDP growth. No landing is probably not that good either, because it means the Fed and the Bank of Canada step in too early, too quick. We don't get a recession, we don't get any job loss, and we skirt out the other side. But what happens in that scenario is likely continued inflation, where they need to come back in at a later date and kind of solve the problem then. We obviously had a great start to the year for equity markets as inflation was easing, bit of weakness near the end of February into the start of March, and then things have been bouncing back again. However, earnings growth continues to fall, and falling inflation with lower earnings growth is definitely not good for forward expectations of earnings. On the positive side, in a way, management across all cohorts, as we've been scouring through earnings reports during Q1, have all really guided down and been extremely cautious with their outlook for 2023 based on this macroeconomic environment. This is the recession that everyone's seen coming. So with that said, markets and us as money managers are always trying to look forward one step ahead. And we think that, should we not get that hard landing in the back half of 2023, could bode well for equities. But with that said, yield curves are still inverted. We were showing that here on the previous slide. Right here, you can see the 10 versus 3s, much lower. It's kind of preceded a lot of the other previous recessions. However, that hasn't really had an impact as of yet from a technical GDP standpoint. A second aspect to this is leading indicators still seem to be quite negative. Those are forward-looking instruments. lagging indicators like unemployment are still baking in quite well. That unemployment or that job front is probably one of the strongest areas of the market, and something you typically don't see during a typical recession. Right now, there's about 2 job openings per unemployed person. That's actually the highest reading ever. So that means that there are jobs out there for people that want them. Part of it is a lack of supply in the workforce. We've seen lower immigration over the last several years, obviously. Some premature deaths from COVID. Labor force participation still remains lower than usual, part of which from premature retirement, with people kind of packing it in early during that recessionary COVID environment. But with all of that said, I'm going to come back to what I was talking about on the China EM side. If you think back to the last Great Recession in 2008, it was a global phenomenon, coast to coast, across every country. If China, the emerging markets in Europe, are able to skirt through this without a technical recession, the effects in the United States and Canada are likely to be fairly muted. That puts us in that soft landing camp. And we believe that that should bode well for equities to not get too badly hit. Again, I try to reiterate this often enough, where equities are not the economy. However, we remain cautious moving into this. We still have high positions in cash and remain steadfast on our position in dividends. The LWC Canadian dividend portfolio is the largest position in a lot of our client households. You can see that you just have a lower standard deviation than the TSX, as well as semi-deviation. That's volatility to the downside at the sacrifice of some up capture, because we're getting just, that 50-55% down capture. So steadfast on dividends, keep some dry powder in the bank. But we did take the opportunity in the weakness in the banking sector to add to some exposure there. We were holding a covered call US bank position for about 2.5% of a portfolio, fairly small position, was definitely not unscathed. It was down about 27% from the peak to trough, but still much better than the 32% we saw in regional banks. We've rolled that into a US bank Canadian hedged version. The Canadian hedged version was down 32% as well, because the CAD kind of moved from 133 to 137 against that position. But you can see here in this chart that the US dollar has been rolling over, and we don't think it's a good time to add our US dollar exposure. So that's why we decided to take the hedged version, as well as kind of double down, buy low on the strategy and on the opportunity. We thought US banks were attractive going into this from a valuation standpoint, and continue to believe in that thesis, and don't think there's the contagion risk. And this ETF, to be clear, is on the larger money center banks, not the regionals. But as you can see, still drew down quite as much as the regionals, which we think is a good entry point. Lastly, selling the covered call aspect is a good time, because with volatility high, you're kind of capturing that volatility. Where are we going with it? We funded this position by selling the CI floating rate income fund. This position was meant to take advantage of a rate hiking regime, which it did quite well through. But with the Bank of Canada on pause here, we thought it was a good time to exit that position to fund both the US bank purchase, as well as reposition into US Treasury bonds. There is some credit risk in the CI floating rate note. And so by moving to US Treasuries, we reduced that credit risk. At that point, bond yields had risen back nearly to 4% on the US 10-year. We didn't quite capture the high, and moved into like the mid belly of the curve, 7 to 10-year bonds. Short interest at that time was really high since 2008, tends to be a good contrarian indicator. And like I said, it was the reason why we hedged the position, was these differentials. You could see here at the top of the trading range is a good time to hedge your CAD position, and near the bottom is a better time to kind of leave it exposed. So those are the moves we made this month. Hopefully I helped explain a little bit on the SVB bank.